There are several things that we like about Itron's current business model. For instance, its efforts towards sustainability, as well as its history of technological advancements. However, this graph represents the true story of Itron. 20 years as a publicly traded company with 16 mergers and acquisitions aggregating a deal value of $3.3 billion. However, Itron's current market capitalization is only $2.4 billion, representing a loss to shareholder value of nearly $1 billion. For this reason, we felt compelled to issue a sell recommendation on Itron. Good afternoon, we are the Whitworth CFA team, and through our analysis, we calculated a target price of $37.25, representing a 36.8% downside as of Monday's close. Our investment thesis is threefold. First, Itron finds itself in an industry categorized by excess capacity and fragmentation. Secondly, its overvalued stock price is a result of excessive optimism towards smart cities, as well as Itron's own operating capabilities. And thirdly, Itron's inefficient M&A capital allocation has resulted in a loss to shareholder value. Itron's business is the manufacturing and distribution of standard and smart meters used to measure and monitor electricity, water, and gas solutions using AMR and AMI technology. Since October, Itron has been in the process of restructuring its business segments into device solutions, network solutions, and outcomes, which involve providing standard meters, smart meters, and analytical services to clients, respectively. In addition to restructuring, Itron has been focusing tremendous efforts on ESG improvement.
Through our evaluation of Itron's ESG score, we have came to the conclusion that Itron's environment and social efforts are doing well. However, their governance raises a red flag. Itron's board of directors is comprised of 9 members and uses a staggered board structure. This means that 1/3 of their members are elected annually, and this is a problem because shareholders are unable to vote out directors that are not meeting their fiduciary duties. Although it's not a governance issue, it's important to note that Itron has a high executive turnover rate. In 2018 alone, 59% of Itron's executive positions changed, and 41% of people outside of the company filled these positions. In fact, current CEO and President Philip Mazie has recently announced that he will be stepping down from his executive position. When comparing this to the rest of the industry, it's very abnormal. Itron has a 7.5% market share in the smart meter industry. Due to fragmentation and excess capacity, it's difficult to establish a significant market share because of ongoing price erosion and commoditization. Secondly, Itron continues to face increased competition, and this creates a high need to find a competitive edge, and this could cause Itron to reduce sales and increase R&D spending, which leads to lower margins. Lastly, some of Itron's competitors are divisions within larger companies, and this is another implicit risk that these larger companies can come in and exacerbate margin pressures further in the industry. Former CFO Steve Helmbrook informed us that Itron shoots for an EBITDA margin in the mid-teens. As you can see, they currently have a 10.2% EBITDA margin and has historically hovered between the 10 and 11% range. This plateau, once again, is primarily due to the ongoing price erosion and commoditization. However, since some of their competitors have reached this mid-teen goal, it implies that Itron's at a weaker competitive position.
In addition to Itron's challenge to reach a mid-teen EBITDA margin, they have also struggled to create value through their M&A transaction. As Parker mentioned earlier, over the past 20 years, Itron has been involved in 16 acquisitions. In 2004, Itron acquired Schlumberger's electric segment for $253 million. In 2007, Itron acquired Acteris for $1.7 billion. And this acquisition contributed 56%. This acquisition contributed 56% in organic growth. When we spoke with former CEO Leroy Nosbaum, he told us out of the 13 M&A transactions he's been involved in, he can only recall 3 of them being a value add to shareholders. Lastly, in 2017, Itron acquired Silver Spring Network. This acquisition more than doubled this acquisition contributed 33% to the total value of 3.1 total backlog. Under the current CEO Felipe Mezzi, Itron has managed to grow its revenue by 3.8% in annual basis over the past 5 years. However, when you remove the impact of the Silver Spring acquisition, they're only managed to grow by 80 basis points. We further analyzed this acquisition by calculating the net present value of their cost synergies. As you can see on the chart, Itron is losing $64 million in this acquisition. Furthermore, we looked at whether Itron is creating economic value by comparing ROIC to WACC. As the graph suggests, over the past 5 years, they have been unable to do so. Furthermore, Itron had 2 major goodwill impairment losses for a total value of $19.33 per share, which further highlight their inefficiency with capital allocation.
We utilized a discounted cash flow to the firm method in order to arrive at a final target price of $37.25. Starting with the main driver of the model, of course, being top-line revenue growth. After the effects of the Silver Springs Networks acquisition in 2018, we forecast revenue to be growing relatively flat at about 2 to 3%. You do see an uptick there at the end of our forecast period due to double-digit growth in their service revenue. And with a growing, higher margin business, we also see an increase in Itron's operating margins. However, we do forecast restructuring costs to continuously negatively impact Itron's operating margins by about 150 basis points annually. Now, for former CFO Steve Helmbrecht, one of the most difficult things about Itron's aggressive and continuous M&A activity is to be then able to consolidate their ERP and IT software all under one system. And after analysis of companies who dealt with similar issues, we forecast CapEx as a percentage of revenue to increase to 3.5% for the next 3 years, which compares to the historical average of 2%. In regards to the weighted average cost of capital, we calculate a 4.9% cost of debt based on the weighted average yield to maturities of Itron's current outstanding bonds, of which 60% of that debt is variable debt. It's also very important to note that Itron's only publicly traded bond is currently trading at a discount, yielding 50 basis points above the 5% coupon rate it was issued at. We calculate an 11.1% cost of equity based on the Farmer-French 3-factor model, which is an extension of the traditional capital approach, allowing us to capture the size risk premium with an Itron. We ultimately use an 8.7% discount rate in our DCF model to arrive at a final target price of $37.25. And embedded in this price target, there are numerous risk factors to consider.
To summarize all the risks that led us to our target price of $37.25, we first need to take a look at the smart meter industry as a whole. This is an industry plagued by price erosion and commoditization of the products due to fragmentation. And this poses 2 major risks for Itron. The first being that competitors within the industry are able to underprice or undercut them, given that they have the means to do so. The second of these risks is that buyers within the industry have a disproportionate amount of bargaining power when making deals with Itron or anyone within the industry. Second, taking a look at Itron's financial risk, given the recent debt that Itron has put on their books, in addition to their plummeting interest coverage ratio, we can see that their relative debt is increasing at a time when Itron's current management team has stated that their main goal is to delever. Finally, taking a look at Itron's operational risk, we see 2 major issues here. The first being the natural event risk that comes with trying to consolidate various IT infrastructures across various industries and countries that Itron operates in. And the second is the supply chain inefficiency issues that Itron's current management team has stated as the main reason for their stagnant sub 2% growth rate in recent years. And Itron's former management and former members of Itron's management team has stated as the main reason for their negative revenue overseas. Now, given the complexity of the smart meter industry as a whole, we felt it applicable to conduct 2 separate forecasting methods. The first of these was a Monte Carlo analysis, and the second was a technical analysis. Both of these confirmed what we thought going in, that a sell is highly recommended.
So to reiterate our investment thesis, Itron's presence in a fragmented industry, its overvalued stock price, and its inefficient M&A capital allocation led us to a sell recommendation of at a target price of $37.25. We now like to answer any questions you may have.
You mentioned the industry is plagued with overcapacity. How did you assess that or reach that conclusion?
So That was first brought to our attention by the former CEO, Leroy Nussbaum. He stated that the industry was plagued by excess capacity, as I mentioned. And so as we dug into the numbers a little bit, we noticed that despite unit sales increasing, revenue growth was staying stagnant. And so that kind of led us to the conclusion that there was little product differentiation, and that was confirmed as we looked at the different products offered by Itron versus its competitors.
And just to add to that, Leroy also said, former CEO Leroy Nussbaum said that the industry produced at an average of about 60 to 70% of their full capacity.
So did you guys just call the former CEO at his house, or how'd you track him down?
We sent him an email, and then we arranged a meeting and a place to meet, actually in Davenport. That's what it's for.
Very creative.
So the company announced their full year 2018 results, their 2019 guidance a couple days ago. I know that's after you turned in your presentation, but just curious your thoughts on 2019 guidance and how your analysis aligns with that, and if the numbers put out by the company changes your outlook.
Not at all. In fact, it mostly confirms what we thought. They lowered guidance in terms of revenue. We have revenue for 2019 about 2.4, which is in the middle of their guidance that came out 2 days ago. The only thing I would say that changed within our model and what we would alter is restructuring costs. They came out and said that 70 million was to be more in fiscal year 2019 and 2020. We had a lot more of that going into 2018 fiscal year because we thought the restructuring costs for their supply chain inefficiencies would occur in Q4, that they're saying they would pass off to 2019 and 2020.
Restructuring costs or savings or both?
Restructuring costs. The savings, I believe, will come later, as stated by Phil Amazing, the conference call.
You guys had mentioned that the management turnover had been extraordinarily high. Isn't that kind of part and parcel for a business that's growing through acquisitions? Essentially, you acquire the business and then you get rid of the top brass and save money so you have the business and you don't have all the costs. So is that really a negative, or is that a positive, and or is that just part of the way that they're looking to grow the business?
When we talked to former Itron executive John Hangish, he informed us that this executive turnover rate was a negative because they were constantly looking to the outside to help. As Messman stated earlier, these M&A activities have not been creating value to shareholders, and so they're trying to find someone from the outside to help grow the revenue instead of the stagnant revenue that we're seeing.
Can we take a look at what you have for interest expense forecast on there? I'm just curious.
So how we forecasted our interest expense, of course, their senior note is a fixed note, but then under their 2018 credit facility, they have about a third of that being hedged, and the other 2/3 is tied to a LIBOR plus the applicable margin of max out of 2%. And so we looked at a forward LIBOR curve to predict out interest expenses moving forward.
Given their long history of acquisitions, do they have a history of acquiring assets and then writing the goodwill down? And if that is the case, in terms of you guys looking at that, given they took on huge amounts of goodwill on these last two acquisitions, do you think that's a risk and or potentially a catalyst to get to your sell target?
Yeah, that was, so Itron had two goodwill impairment charges, one in 2011 and then the other one in 2013 for a total value of close to $700 million. And then I think as they continue to do these acquisitions where it doesn't add any sort of value, we believe that might have to do again, these charges again. And then it's kind of like what we see across various, companies in the industry as well.
And also to add to that, when we spoke with former CFO Steve Helmbrecht, he informed us the timing was also an issue when they acquired Acteris. It was at the top of the markets before the volatility occurred in 2008 and 2009. And when they acquired Silver Springs, again, at the end of 2017, the market was going on the run. So that could impact the goodwill impairment charges moving forward.
I saw in your free cash flow model, your forward free cash flow model, it looks like you have pretty significant free cash flow growth from 2018 to 2019. I'm just kind of curious, what's driving that, and that kind of seems like a positive to me, but you still have a pretty hard sell rating on the company. Can you talk through your thoughts and reasoning on that?
Yeah, so even though it is an increase, again, I'd like to point out we talked about EBITDA margins. So even though they are increasing compared to competitors, it's still not quite to the level they are at. and the 2018 to 2019 increase, a lot of that has to do with the decreasing restructuring costs.
On that, actually, I have a question on the EBITDA margin. You said that, a lot of their competitors, that they have target EBITDA margins kind of in the mid-teens, and a lot of their competitors are already in that neighborhood. How would you, given that you have a sell rating, how would you characterize the risk that, their underperformance could, shift, that they could recover and start to perform more in line with their actual peer group, and see their EBITDA margins go up?
Actually, can you repeat that question?
Yeah, how would you characterize the risk that their EBITDA margins could trend towards their peer group in the mid-teens where they have targets?
Yeah, so I would say, if you look at their competitors, again, they are slightly underperforming, but in terms of the EBITDA margins, I would also like to note that the non-GAAP EBITDA margins are actually EBITDAR, so putting in, again, that restructuring cost. So our main concern is, after speaking with former executives of the Itron team, the supply chain inefficiency problems that they continue to deal with, especially overseas in Europe, that's tied to that restructuring cost, but it's still kind of the economics of the industry as well as Itron as a whole. And I think if they're able to solve that, they still have this cash out expense of the restructuring cost to improve their EBITDA margins. So they need to take a note, I think, in terms of, yes, they are spending that money to improve that EBITDA margins, but it's not just an increase in EBITDA margins without that cash outflow with restructuring costs.
On the recent earnings call, the management team mentioned that PG&E going bankrupt, that could potentially be a positive for the company going forward. Do you guys have any idea why that would, you would think having a primary customer go bankrupt would be a negative, not a positive, but what do you think their spin is in terms of how PG&E's problems could turn into an opportunity for them?
So PG&E being a utility player, so it'd be like, let's say that Vista having the exact same thing, but in terms of the bankruptcy, again, it's a government-owned utility. So I'm going to kind of put off the bankruptcy risk, but more so on they're going to need to have to supply more meters. I just don't know in terms of Itron. They don't really break down where they operate geographically, but they did mention, of course, it could be a bonus because they're going to have more meters deployed because of what happened with PG&E in the state of California.
So, given your sell rating, what would you have to see from the company in order to change that to a hold or maybe potentially a buy?
Well, again, going back to our risk assessment, the largest risk that we found was their supply chain inefficiency issues. So, and the biggest risk that we found was their supply chain inefficiency issues. And a big example of this was after speaking with former executive John Hangish, we found that when they moved a major manufacturing plant to Mexico, when they moved a major manufacturing plant to Mexico, they saw unmet demand and inability to consolidate their IT infrastructure. So if they could somehow figure out a way, if Itron could somehow figure out a way to better consolidate these issues, and if Itron could figure out a way to better consolidate these issues, we believe that our rating would increase to possibly.
Yeah, and two things. It's a one-year target price, so I believe that we do see double-digit growth in the service revenue. But again, it's hard to forecast that out the 5-year period that we do. So that one-year target price is going to be, indicative of how much service revenue they get. And also to add to Jason's point, yesterday, Tom, COO of Itron, did mention the movement of manufacturing plant and how that affected product X to product Y and their movement, again, of supply chain inefficiencies.
Do you guys think in terms of, it seemed like your long-term kind of insurance, your growth rates into infinitum or whatever seemed very, very low. I think that you guys are forecasting like 2 or 3%. That's basically GDP growth.
Yep.
I look at this as kind of a potential high growth business, and smart meters and kind of their whole business are positioned to grow over the next 10, 20 years. Do you think there's a risk that your long-term growth assumptions may be a little low?
No, because I think it's very hard to justify above a 2% GDP growth rate, given how sensitive the DCF model is to that growth rate. So what we did was looked at a higher growth component in their service revenue, capturing that smart meters. And when we spoke with Dan James,
Yeah. All right, thank you guys.
Yeah, guys.